Hey, good morning. Let's go over today's trade plan. So in the overnight session, we were watching NASDAQ 4435 and Russell 1250 level to determine short-term directional bias. The failure of those levels in those other markets resulted in a continuation move lower in the S&P and a test of the 68 quarter to 70 quarter support zone where responsive buyers were again active. At this point, heading into the open, we're going to be using the 76 quarter to 78 quarter zone to adjust our short-term directional bias. At the same time, we are still going to keep an eye on the 1250 HVN in the Russell and on the upside, the 4435 high volume node in NQ. And if those other markets can break those levels to the upside with the S&P breaking out above 76 quarter, 78 quarter, then that would result in some short-term upside momentum and we can get a move up to the prior VPOC of 84.5 and the initial resistance zone of 85 to 87. Now, given the recent trend, which has been more on the downside, sellers can still be active on first test of the resistance zones, but we just have to gauge the level of momentum and the broad market participation or broad market strength or weakness on the advanced decline to determine whether there is still potential for ES to head lower on the day time frame, or has it now put in a short-term swing low and can now put in a correction back to the upside, heading back up towards 93 to 95 half. Because so far overnight, the markets are running on above average volume, which means we can get a pretty decent sized range if that trend continues after the open. So if off the open, we're still running on above average volume and we're maintaining that level of volume, then we can get a 20 to 25 point range on the day time frame. So, that means that on the upside, if we really start pushing with some momentum, then we don't necessarily have to stop at 85 to 87. Now, again, that's something we do have to determine in real time because, ES can fail there and then go right back down towards 68 quarter to 70 quarter, right? That's yet to be determined, and it's going to depend on how these other markets behave, and again, just the level of strength or weakness we're seeing on the day time frame and how the market approaches 85, 87. That's going to help us make that determination and judgment call. But 85, 87 is active resistance until broken. Beyond that, we have a short-term resistance level at 89, and then the next main inflection point on the upside is 93 to 95 half, where the expectation is for responsive sellers to be active in the market. Now, on the downside, if the market fails and holds below 76 quarter, 78 quarter, then we can just go back down and test the 68 quarter, 70 quarter zone again, the initial support zone on the day time frame. Now, as we go down there, just keep in mind that that would be a second test of that zone. That the first test, the high probability reaction, has already taken place. So if the day is shaping up to be a liquidation type day or a trend down type day where the other markets are also selling off, then we don't have to stop on the downside at initial support. Then we can go down to 63, 65, perhaps get a reaction there. And even there we have to be careful because now the 68 quarter, 70 quarter zone is going to be acting as short-term resistance, right? So if you're taking a long setup at 63, 65, just have to understand that right above you have overhead resistance. And again, if we're going down there on a day where it's shaping up to be a long liquidation, trend down type day, then it'll be better to use those zones as targets on shorts rather than spots to fade the market. Now 57.5 to 59.5 is a pretty decent support area. That is essentially the prior swing low. So in the event that we extend down into 57.5, 59.5, that's an area where we can get a decent buy response. Below that, 50.75 to 52.75 is a pretty decent area of support where it can shut off the selling and reverse the market back up. So we are approaching some pretty decent areas of support. And if we look at the other markets, we can see that they're still really not showing the same level of weakness that we're seeing in the S&P. For example, the Russell overall is holding up quite well. ES is relatively weak compared to those other markets, at least in the short term here, and it has for the most part been leading to the downside. And Nasdaq has been kind of moving somewhat in lockstep, but Russell has been holding up quite well, and Russell used to be actually the weaker market. So right now there are these disconnects that are in play, these divergences that are in play in the market, and we know that once those divergences actually correct, or once these markets come back into sync with each other, that can be a pretty decent sized move across the board. So, at this point, the short-term bias is going to be bearish below 76 quarter to 78 quarter, with the understanding that, we are going to have to see some liquidation type internals, or, some weakness, at least on the internals, in order to continue going lower. And at the same time, we're going to want to see a failure in the Russell at 49 to 51 area, 1249 to 1251, in order to support that downside continuation move as well. But right now, with the markets running on high volume, we know that we can get some increase in volatility here, some better ranges on the day time frame. So we have to be just prepared for a move. Really, if we're holding above micro bull bear zone, we can go up to 85, 87. If we take that out, the next main inflection point, 93, 95 half. On the downside, if we're holding below the micro bull bear, then we can head lower as low as 57 half to 59 half. But at the very minimum, a retest of initial support could play out, and then we'll gauge and see kind of how the market's behaving there. Below there, 63, 65. And then the major support area is really 57 half to 59 half, and 50.75 to 52.75. But we're still in this market that requires a very nimble and flexible mindset, and you have to be flexible with your short-term bias as day traders. We know that the trend so far has been more to the downside recently for the last 3 to 4 days, but at the same time, the market's quite oversold into the 68 quarter, 70 quarter zone, and short term we can just kind of correct now and balance within a range. So as a day trader, you have to be willing to go long or short on the day time frame here, because we can simply get some volatility within a range here. So those are really the main ideas heading into the open. Let's see how the market reacts to the micro bull bear zone. If we take that out, then we'll know that the short term directional bias is to the upside, but bigger picture, sellers can still be active at 85, 87, and 93 to 95 half. So those are the main ideas. Let's see how the market reacts to the bull bear, and that'll help us set the tone for the day, and we'll take it from there.